Right. So once again, colleagues, I welcome you to our second lecture session for FAC 1503 with Grad Consulting. My name is Mr. Privilege. So from the previous lecture that we dealt with, we covered a number of items pertaining to chapter 1. All right. And one of the things that we began to cover was pertaining to the fundamental theoretical principles. And then, of course, there is also what we call enhancing fundamental principles. So with the fundamental theoretical principles, we discovered that there are two important aspects to take note of. Of course, they are, which is separate from the assumptions, all right? Which is separate from the underlying assumptions. Now, the underlying assumptions does not necessarily refer to the fundamental theoretical principles. And by the way, just so that you can have a much lighter understanding of what is happening there, when they say fundamental theoretical principles, they are also referring to what they call fundamental characteristics of, I'll just try to abbreviate, financial statements, okay? Fundamental characteristics of financial statements. It's really one and the same thing. And there are literally two of those, which is number one, relevancy. And we began to look at those last week, obviously. So we talked about relevancy and we also spoke about faithful presentation. Faithful presentation. So when you're talking about fundamental theoretical principles or fundamental characteristics of financial statements, three important principles that needs to be evident in the presented financial statements or information is that the information should have some sense or level of relevancy, and also it should be faithfully presented. And just to summarize, when you're saying that the information has to be faithfully presented, we simply mean that the information should be free from error. The information should be complete and useful to the user. All right, useful to the user. Very important to remember about faithful presentation, right? Then, so today what I'll then begin to explain to you, so I've already explained about those things here, relevancy and faithful presentation. So I'm not gonna repeat all of that. The other ones that you see here, okay, so the issue that information should be complete, useful to the user, or it should have some degree of neutrality, meaning to say it has been presented without any form of conflict of interest or bias that arise, and then free from error. So that was faithful presentation. Now there is what they call enhancing qualitative characteristics. With the enhancing qualitative characteristics, these ones, they just actually complement the fundamental theoretical principles. So there are four of those that you need to really pay attention to. So there is comparability. All right. So this is basically to say, with enhancing qualitative characteristics, the information should be, number one, comparable. Number two, verifiable. So when they're saying verifiability, it means you can verify the information, right? And with verification, or when they say information should be verifiable, it implies that the information can be audited. Can be audited, very important. Then of course, number three, it should be prepared. Information should be prepared in a timely manner, which is the same thing as timeliness. And number four, comparability, verifiability. And then the last one is understandability. So information that is generated should be understandable information. So these are the attributes of enhancing qualitative characteristics. So for theory purposes, you just need to be able to distinguish the differences between fundamental and enhancing qualitative characteristics. Remember, with fundamental, there are two, which is what? Relevancy, faithful representation. And then with enhancing qualitative characteristics, there are four, which is comparability, or information should be comparable, verifiability, timeliness, and understandability. Very important to remember this. Very important to remember this, guys. Right. So I just wanted to make sure that at least we complete on that. And I also began to explain in lecture 1 about the elements of financial statements, but not in a greater detail, because the in-detail discussion about these financial statements, you find it in learning unit number 2, which is what I want to try and channel your focus towards in this lesson for today. So, but essentially, so as I begin to explain each one of those, I'm going to be using a whiteboard screen so that you can have a clear understanding of each one of these elements. So, colleagues, when you're talking of the elements of the financial statements, all right, there's such a thing called an asset. There's such a thing called a liability. There's such a thing called equity. There's such a thing called income and expense, which you can clearly identify or clearly observe when you look into the financial statements of any organization of note, right? So now, when you're talking of these, just so that I can explain them at a high level before I get into the details of things, I'm going to start off with an asset just so that you can gain an overview understanding, all right? So there's a definition for each element. You need to know just the definition. And number 2, classification of each one of these elements. Very important. So I'm going to, of course, the definition, I'll explain it when I get to the detailed aspect about this element. But essentially, with an asset, there are 2 groups of assets, which is namely current assets, and then there's also what we call non-current assets. I'm going to explain what that means and their distinction between, the distinction between the two. So there's such a thing called non-current assets when you're dealing with assets. All right. Just as an overview, brief description of an asset. So an asset, essentially, it's refers to the economic resource under the control of an entity in fact, let me break it down for you so that it makes more sense, because with bullet points, you'll be able to understand it better. Right. So we're saying that an asset essentially
leader. So leader, somebody talking is on your background, or is somebody else?
Oh, okay. Let me mute. Let me mute. All right. Perfect. So we are saying an asset can be defined as an economic resource, all right, under the control of an entity as a result of a past event. All right, with an expectation of inflow of economic benefits. In fact, I've just given you the whole definition. With an expectation of inflow of economic benefit. That's what an asset is. So it's an economic resource under the control of an entity as a result of a past event, with an expectation of inflow, all right, or resulting in flow of economic benefits. Now, we need to understand when you're saying an asset is an economic resource, what does that imply? So when you're saying that an asset is an economic resource it can be attributed to as a right. So you can have a right to receive money. You can have a right to exercise or to determine the use of an object that you are owning. Very important. So when you're talking of an economic resource, it refers to rights. And these rights we're referring to, it can be a right to use, let me put it this way, to determine the use of an object. Not only that, but the right can also refer to the right to receive economic benefits. The right to receive economic benefits. So when you're saying the right to receive economic benefits, it can refer the right to receive actual cash. All right. Maybe as a payment from a client who had acquired certain items on credit from the organization. Right. Very, very important, colleagues, to take note of this. So what am I doing? I'm trying to make sure that you at least get the theoretical understanding of what this element is. Of course, in Learning Unit 2, that's where all these things are dealt with in detail. But I want to illustrate with one element for now before I get to discuss the other ones in detail. So you need to know the definition, guys. Very important. And then also to understand the classification of each one of these elements. And lastly, but not least, you also should be able to understand the accounting behind it. What do I mean when I'm saying understand the accounting behind? So we are saying that since and we understand what an asset is, and we understand that it can be grouped into two, which is current assets and non-current assets, which I will explain the distinction between them. When you're saying the accounting behind it, what do we mean? So when I'm saying the accounting behind, we're trying to understand, okay, first of all, under what circumstances would we see assets increasing? So when you're saying assets are increasing, what would be the cause and how do you account for such an increase in assets? So obviously, we will have to debit the asset account. I will illustrate on the whiteboard what I'm writing down for you, right? And then when assets decrease, what is the accounting behind it? Obviously, we would have to credit the asset account. But what does all of these things really mean? Because as it is right now, from a theoretical point of view, you're still trying to understand, or you're still trying to, to make sense of what I'm writing in front of you, which is not a problem. So over the whiteboard screen, that's where I'm going to illustrate, starting with an asset, obviously. So I've already given you guys a definition of what an asset is. I've already given you the definition, right? So, but now what I want to explain is the accounting behind. Okay, that's what I want to try and explain. So when you're saying the accounting behind, under normal circumstances, all right, there's what we call a ledger account for an asset. So I want to show you what causes an asset to increase and what causes an asset to decrease. Very important. So the arrow going up simply represents circumstances which would cause an asset to increase. And then with the arrow facing down is just simply to show you guys circumstances that may cause an asset to decrease. So in accounting, there's such a thing called ledger accounts. So in a ledger account, supposing it's an asset account that you have opened, and you just want to evaluate whether assets are increasing with respect to that group or class of assets, you would see the reflection on the debit side of the asset account. So all the time, assets will always increase on the debit side of the asset ledger account. I want to repeat that statement. Assets would always increase on the debit side in the ledger account for such an asset account. Assets would always decrease on the credit side of such an applicable asset account. So there are different groups, different types of assets. Remember, I've mentioned earlier that assets can be classified into two. We've got current assets, then we've got non-current assets. So the distinction is this. Current assets, all right, current assets are those type of assets with a useful life of 1 year or less. So let me write it down because I don't want you guys to miss anything here. Okay. Just a sec. All right. So I just want to go back to the footnote because that's where I was summarizing these things for you guys. Right. There we go. Right. So I want to try and explain to you the classification of assets. All right. The classification of assets over here. That's what I'm trying to explain. So let me do this so that it becomes easier. So with A, I'm simply referring to the definition of an asset, and then when I put B, I'm referring to the classification of an asset. And then of course, C, that's where I'll be explaining the accounting behind. So with C, what I'm just trying to explain to you guys is the accounting behind, or understanding the accounting behind this particular element of the financial statements, which is an asset. All right. Right. So we're saying an asset by definition is this one, the classification. So there are two groups of assets. There's such a thing called a current asset. And then there's such a thing called non-current assets. So the difference between the two is it's simple. With current assets, these are, so they are useful life rather. It's 1 year and below. So the key difference is just their useful life. How long would that asset last under the control of the organization? So whereas with non-current assets, these ones, their useful life more than 1 year. So it can go as far as 20 years, 5 years, 2 years. For as long as it's above 1 year, it means that type of an asset you're dealing with, it's a non-current asset. I'm going to give you examples. So let's start off with the current assets. So with current assets, you would have such a thing called debtors control. Now, debtors control is the same thing as referring to people owing you money. And then in the context of you as a practicing attorney, we call this client control. Client control, all right? So it's a current asset. Then another group of assets which are considered as current assets can also involve inventory, right? It can also involve bank. And with bank, there are two types, okay? So there's such a thing called trust bank, and there's such a thing called business bank. All of these are current assets by nature. For as long as the bank balance is positive, okay? It means it's an asset, and in particular, a current asset. So you can have money in your trust bank account. So when you want to account for it, or when you want to classify that, that account in terms of, you know, elements of financial statements, it will be classified as a current asset. All right. That is if there is money in that bank account. Similarly, with the business account, if there is money, it will be grouped as part of your current assets, which is basically those assets with a useful life of 1 year and below. With non-current assets, these are those type of assets with a useful life of 1 year, of sort of more than 1 year, right? So their useful lives is more than 1 year at most. Now, what are those typical types of assets with useful life of more than a year? This can be land, buildings, vehicle, machinery, equipment, financial assets. Now, with financial assets, for chapter 8, that's where you'll see things like trust investment accounts, trust investment accounts, all right? But this I'll deal with it in detail in chapter 8 of your prescribed material, right? But what I want you to draw is that from the classification of assets, there are 2 groups. There is such a thing called current assets, and then there's such a group of assets which can be referred to as non-current assets. Very important, guys, to remember this. And then the accounting behind it is such that assets would always increase on the debit side of the ledger, which is what I was showing you now earlier on from the whiteboard screen, to say assets would always increase on the debit side and they'll always decrease on the credit side. Now, I want to answer the question, which is to say, what are those events that causes assets to increase on the debit side? So assets increase when we purchase new assets. Very important. Not only that, sometimes there are certain assets which are not objects in nature. I mean, to say physical, but it can be money. So when a client is owing you money as a practicing attorney, and then they pay you, right? And then they pay you money. So that means you are receiving an asset. So these are the 2 important events that causes assets to increase. So obviously to be that specific asset that you have either purchased or that you have either...
Sorry, my leader.
Yes, sir.
You mentioned the fact that assets increases when you purchase new assets.
Yes, correct.
And you said when you receive an asset, how do you receive that assets by? I mean,
right.
How
so
do you receive it?
Good question. So when you're receiving assets, it can be a case whereby a client is owing you money, right? So when they begin to pay you what they are owing you, that can also increase your asset, in particular to be bank, because you are receiving money. So your bank account is going to increase when you receive money. So two important things that causes assets to increase. It's either you're buying the asset, think about it, buying assets which are physical in nature, such as inventory, such as land and buildings, or buying a new car, or buying a new office equipment, tables and chairs. So when you buy those assets, right, the record in that specific asset account or the asset that you have acquired, it will be recorded as a debit in that asset account when you buy. But when you're receiving, remember, receiving part of it, it's where you receive money in particular. All right. So, sometimes you can receive it. An asset is a donation. Think about a public organization. With public organizations, they are, they're not a profit company. So under normal circumstances, their revenue or what they depend on normally, it's from donation. So such a company like that, they can also even receive a donation in form of a physical set of chairs, set of tables, and all that, which could be used by the organization in question. So when they receive such assets, when you record office equipment in that respect, you have to debit it. So you have to debit the office equipment account when you receive office equipment assets in form of chairs and tables. Right. I don't know if I've answered your question, leader.
No, thanks, leader. It's very clear.
Perfect, perfect. Then on the other hand, we want to deal with the circumstances which causes assets to decrease. We want to show circumstances that causes assets to decrease, right? So under what circumstances would we see assets decreasing? No problem. So assets would decrease, number one, when you sold an asset. Assets decrease when they are destroyed. It could be as a result of a natural disaster occurrence, all right? Or it could be maybe that it was a vehicle, it got involved in an accident. What happened? It means that asset has deteriorated or got destroyed. So it means if you had 5 vehicles to the value of maybe 2 million rands in your account, and one of them has been involved in an accident, it means the vehicle account has to be reduced by that value of the asset that got destroyed. So maybe the value of that car was 200,000. So here on the credit side, we have to put the entry 200,000 to reflect the decrease in the motor vehicle asset account. Is it making sense, colleagues? Right. So
you're saying when an asset is being destroyed,
yeah,
probably we are expected now to lose a certain amount of money of 200,000. Then you have to put it on the credit side.
Correct. Correct. So maybe let's say that was the market value of that asset
of that particular car. So therefore, you lost 200,000.
Correct. Correct. So that's how you would account for it in the asset account, of course. But there are other issues. Other accounting principles behind it, which I don't want to explain for now, right? So assets decrease when you sell. Assets decrease when they are destroyed naturally, or maybe there was an accident that took place. Sometimes you can give away assets. So when you have donated or given away a particular group of assets, in your records, those assets would decrease effectively. So think about it, maybe say your business is a furniture shop and you decide to give away 5 tables. So of course, those tables you're giving away, it's part of your inventory as a business. So in the inventory account, we are expecting to see that an entry on the credit side reflecting the donation or reflecting the value of the office equipment tables that you have donated. It has to be reflected on the credit side of your office equipment account.
So basically, leader, if you have a promise a donation, they will reflect an amount of that particular donation, or rather they might actually only say donation. Therefore, then you'll put donation on the credit side.
Correct.
If they've actually mentioned the amount of that particular donated asset, then we'll put that particular amount.
Yes. So let's say the donated equipment was to the value of 50,000. So here you would write an entry donation and you put the value 50,000 on the credit side of the office equipment account.
Okay.
That's how the entry would look like.
Okay. I got it.
Perfect. Perfect. All right. Then now, so this was to help you to understand circumstances whereby an asset perhaps was destroyed as a result of, in a circumstance which causes assets to decrease, which is 3 circumstances: where an asset was sold, or where an asset was actually destroyed, or where an asset was donated. That would cause that particular asset, either that has been sold, to decrease, or either that asset that has been destroyed to be decreased, or either an asset that has been donated to be decreased. Very, very important. Very important to take note of that. So now, what kind of questions are you going to get concerning this? So the kind of questions they can ask you regarding to where they are testing you about an asset, they'll give you, all right? They'll give you a set of transactions. they'll give you a set of transactions to analyze. And when they give you those set of transactions to analyze, what they might just want you to do, all right, they would want you to identify in the transaction the account to be debited, as well as the account to be credited. The account to be credited. And then here, they would want you to show the effects on the basic accounting equation. Like something like this. So this is just basically the effect on the basic accounting. Because of space, I have to do this. Basic accounting equation. So they would want you to show the effect on the basic accounting equation like this. So now, what they are checking for in the first two columns over here, they are testing you on what we call the double entry principle. That's what they are trying to test you on here. When they say identify one account that is to be debited, one account that is to be credited. And then of course here, when they're saying display the effects on the basic accounting equation, it can be, so the effect can either be a negative one, or the effect can be a positive one. So you have to show the value either with a negative sign in front of it or with a positive sign in front of it, right? Now, very important to take note of what I've just explained to you. So I've explained to you circumstances that causes assets to increase. So when you buy, for example, a new vehicle, the account that is to be debited, it is that asset that you have bought. So that is what is supposed to be debited whenever you have bought a new asset. Same story, even if you have received the asset, the account to be debited all the time is the asset that you've received, which is increasing. Now the question is, so if I'm debiting vehicles because we've bought a new vehicle, what would be the contra account that I should be crediting? Right. So now I want to explain to you what this means. All right. I'm talking about the double entry principle, because when you go to chapter 2 in your material, they introduce you to the concept with respect to, excuse me, let me just close this document here, with respect to the double entry principle. So I'm going to quickly show you, just to show you what they are testing in Learning Unit 2. It's pertaining to the double entry system. Okay, of course, they also talk about source documents, which I will do. I'll explain about source documents later. But what I want you to understand is the double entry principle. What does it entail? So if you go on page 4 of your study material, all right, if you go to page 4 of your study material, what you will discover there, they begin to explain to you, like for instance, okay, that assets in, okay, I mean, they begin to explain the principle itself. What does the double entry system imply? All right, so the double entry principle simply implies there will always be two sides or aspects to every business transaction. Hence, if in my own summary, this is how I would explain a double entry principle to you so that it becomes easier to understand it. Double entry system, or sometimes they call it double entry principle. Here is how it works. So the double entry system or the double entry principle is that there's always two sides or two effects to a transaction. That simply means when I'm recording, all right, for every debit entry made, there should be a corresponding credit entry to be made. In simple, plain English. So what if I debit something, there has to be a corresponding effect on the credit side. That's what it means. So we're saying for every debit, there should be a corresponding credit. So if I'm debiting the account for vehicle, which I've just bought, for the value 150,000 rands, what is the corresponding entry which I will be crediting here? So if I have bought a new vehicle, I'm debiting vehicle because vehicles are increasing. New assets have been bought. But what will be the entry that will be corresponding to that debit entry? The answer is this. It will be the manner in which you have acquired that asset. So remember, you can buy assets for cash or you can buy them on credit. So if I bought it for cash, the credit account, it will be bank. Why? Money is going out. The asset bank is reduced on the credit side because we have bought a new asset for cash. All right. So essentially, whenever you see any transaction that involves money, I want you to take note of this. Any transaction involving money, there will always be this account called bank, which will be affected. Either you are debiting the bank account or you will be crediting the bank account for as long as they mention anything to do with cash. And you are trying to answer a question that has to do with what account is to be debited, what account to be credited. The moment you see they mention cash, to say an asset was bought for cash, an asset was sold for cash, effectively, what should come into your mind is that there is an account bank, which I'm either going to debit or which I'm either going to be crediting. Very, very important. So what I've just illustrated in this case, where I'm crediting bank, I'm showing you a scenario whereby money was used to buy an asset. So money is going out. Assets in form of bank will be decreasing. Hence, we are crediting bank. And then the other asset, of course, which has been bought in this case, it's increasing in form of vehicles. Hence, you see we have debited the vehicle account to the value of 150,000.
Oh, sorry, leader.
Yes, sir.
I want to check with you. Now, yes, I understand that. To say now, you have bought a car with 150,000. Yes. Yes. Then, therefore, you'll actually will debit the 150,000, vehicle and 150,000,
Correct.
And then the bank will be credited.
Correct.
Now, when you buy that on credit, is it the same thing, or is it, what are you crediting when you?
That's a very good question. That one, I'll explain it in video B of our engagement. So you just connect using the same link. Because we are left with a minute for first session.